Most of us were taught that a savings account is the safest place for our money. We check the balance, see it growing slightly, and feel a sense of security. But there is a silent decay happening to those dollars, a process your bank relies on you never questioning. To see the problem, look at the spread on this chart. The national average interest rate on a regular savings account in the United States currently sits around 0.6%. Meanwhile, inflation is moving at roughly 3% per year. The bank is replacing less than a quarter of the value you are losing to rising costs. This leaves you with a net negative of 2.4% every single year. A $10,000 balance might look the same on your screen, but in real terms, its purchasing power drops to $9,760 in 12 months. By year 2, it is $9,520. This means that simply holding cash results in a steady loss of wealth. While you follow the traditional rules of being responsible, the real value of your hard-earned savings continues to evaporate. This passbook represents an old way of thinking. The traditional savings model is structurally broken for the average person, and staying ahead of the math requires changing how you move your money. To understand why the rates are so low, we have to look at what a deposit actually is. When you move money into a savings account, you are not placing it in a vault for safekeeping. You are extending a low-interest loan to the bank. As this map shows, the bank takes your deposit and immediately puts it to work. They pull your cash with millions of other people to fund mortgages, car loans, and credit card balances for other customers. The bank typically charges those borrowers anywhere from 7 to 24% interest. Because they only pay you 0.6% for the use of your money, they keep the massive difference as profit. This structure turns your savings into the bank's most affordable source of capital. These accounts are useful for immediate liquidity in an emergency, but they lack the mechanics necessary to grow your net worth over time. Moving forward requires a new hierarchy for your cash, a 4-step priority list designed to allocate each dollar where it provides the highest return. The first step is to eliminate high-interest debt. Credit cards and personal loans are a constant drain on your potential wealth and must be cleared before you do anything else. The math here is absolute. If you pay off a balance with a 22% APR, you have effectively locked in a 22% return on that money. No traditional investment can offer that kind of guaranteed yield. Step 2 is to relocate your 3 to 6 month emergency fund. You need that money to stay safe and accessible, but it should not be sitting in a standard account. Instead, use an online high-yield savings account. Because these institutions do not maintain physical branch locations, they have much lower overhead. They pass savings to you through interest rates, often 10 times higher than the national average. These accounts carry the same FDIC insurance as a traditional bank. You get the same level of protection for your principal, but your money works significantly harder while it sits. Clearing debt and maximizing your interest only stops the bleeding. To build a sustainable financial future, you must move into the next tier of the hierarchy. This brings up a problem: money you might need in the next 1 to 5 years. You cannot risk market downturns, but you also cannot let inflation erode capital while you wait. Step 3 uses government-backed tools like Bonds and Treasury bills as a midterm shield. These instruments from the U.S. Treasury are designed to pace with inflation or current interest rates. They allow you to protect your midterm savings purchasing power without the volatility of stocks. Step 4 is the engine for your long-term growth, the index fund. Instead of betting on one company, an index fund lets you own pieces of the 500 largest businesses. Historically averaging 10%, this market compound growth over 30 years drastically scales your initial investment compared to a flatlining savings account. By holding these funds in a Roth IRA, you also avoid future taxes on those gains. This allows the full weight of that compound interest to stay in your account, rather than being diverted to the government. Real financial stability is built by systematically moving your money into assets that grow faster than the cost of living. The primary barrier for most people is the feeling that a bank account is safe. But if your interest rate is lower than the rate of inflation, that safety is an illusion that costs you money every day. Wealthy outcomes are not just about what you earn. They are decided by where that money goes once it hits your account. Follow the ladder. Eliminate the high-interest debt. Move your emergency fund to a high-yield account. Use government bonds for midterm goals, and use index funds for the long term. You can start today. Open a high-yield account to protect your current savings and create a plan to clear your most expensive debt. Your bank is focused on profits, not your retirement, It is your responsibility to make your money work for you. Let's get to work. To keep track of these shifts in the global economy, hit the subscribe button and drop a like on this video.